This episode is brought to you by CertFuel. They've got a full Securities Industry Essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted just like the real thing. Check it out at certfuel.com.
Absolutely check them out.
Right. So I want you to imagine going to the grocery store, right? You grab a gallon of milk. There's a sticker on it that says $4.99, and you walk up to the register.
Pretty standard Tuesday.
Yeah, exactly. But by the time you reach the cashier, they look at you and say, actually, it's $6 now.
Oh, wow.
And you start to argue, obviously, but suddenly the person in line right behind you yells, I'll pay $7 for it. And just like that, the cashier rips the milk out of your hands and sells it to them.
I mean, that sounds like absolute chaos.
It's totally wild. But that high-speed, invisible negotiation where prices just sort of shift beneath your feet, that is the baseline reality of the financial market.
It really is a completely different paradigm.
Yeah.
I mean, we are so conditioned to, transparent, fixed pricing in our everyday lives.
Right.
But the financial market is a living, breathing auction. And it's happening in like fractions of a penny.
Yeah.
And if you don't fundamentally understand the mechanics of how that auction works, you aren't just going to be confused. You are going to be the one funding everyone else's profits.
Which perfectly brings us to our mission for today's deep dive. We are tackling orders and strategy.
That's core stuff.
Exactly. Because before you can even dream of building some complex portfolio or, debating the merits of margin debt or settlement cycles, you have to understand the physical plumbing of the market.
How a trade actually happens.
Right. And if you are listening to this right now as you prep for your Securities Industry Essentials exam, we need to raise the stakes immediately.
Oh, absolutely. Why should you care about the minutiae of these rules? Because this specific section makes up a massive 31% of your SIE exam.
Wait. 31%.
Yeah, 31%. We are talking about roughly 23 questions pulling directly from the concepts we're about to just tear apart today. This is the foundation.
You literally cannot pass the exam if you do not understand this. Like, you can't just memorize flashcards while you're half asleep on the treadmill.
No, definitely not.
But, standard dry textbook lectures, reading FINRA Rule numbers out loud will just make your brain shut off. So we're doing this differently.
We really need these concepts to stick. So to help us navigate these incredibly dense rules, we are going to use 3 fictional characters today.
I love this.
Yeah, I want you, the listener, to visualize them right now. Because when you are sitting in that sterile testing center, just staring at a confusing question, these characters are going to give you the answer.
Okay, let's meet them. First, we have Cautious Carl.
Ah, Carl!
Yeah, Carl is terrified of losing money. He checks his portfolio like 14 times a day. He demands limits on absolutely everything, only takes the most calculated mathematical risks.
He probably sleeps with his emergency cash stuffed inside a fireproof safe under his bed.
Literally. That is Cautious Carl.
Okay, next up we have Daring Diane. She's the exact polar opposite.
The complete opposite.
Diane is this aggressive, adrenaline-fueled trader who just loves wild bets, massive leverage, and she wants everything executed immediately.
Speed is everything for her.
Right. If there is like a 1% chance for an infinite return, she does not care if there's an infinite risk attached to it. Speed and size are her only metrics.
And finally, we have Slippery Sam.
Oh boy.
Sam is a registered representative, a broker, and Sam is constantly trying to, cut corners, ignore the finer points of compliance regulations, and hide behind any semantic loophole he can find to boost his own commissions.
He's not exactly a cartoon villain, but he definitely operates aggressively in the gray areas.
Yeah, he pushes the limits. So Carl, Diane, and Sam, they are our proxies for 31% of your exam.
Perfect.
Okay, let's unpack this. Before Cautious Carl or Daring Diane can place a trade, we have to understand how prices are even set. Let's start with section 1, the basics. Bids, asks, and frankly, how you get finessed by the system.
I think finessed is the perfect word there. You see, every actively traded security in the market doesn't just have a single price.
Right, there's 2.
Exactly. It has 2 prices quoted simultaneously by the dealers who make the market. You have the bid and you have the ask, which is also sometimes called the offer.
To make this tangible, let's totally abandon Wall Street for a second.
Good idea.
Think about buying a used car. You drive onto a massive dealership lot and you see a car you want. The dealer has a neon sticker on the windshield that says $10,000.
Right.
That is the absolute lowest price the dealer is willing to accept to part with that car.
In market terminology, that is the ask. The dealer is asking the public for $10,000.
Okay, now flip the scenario. You are trying to sell your old beat-up sedan to that exact same dealer. You roll onto the lot, the dealer kicks the tires, checks the engine, and says, I'll take it off your hands for $8,000.
Yep.
That is the bid. That is the highest price the dealer, who is the buyer in this specific interaction, is willing to pay you.
And the space between those two numbers, that $2,000,
Yeah.
that is the spread. And who keeps the spread?
The dealer does.
Exactly. The dealer always wins the spread.
And this brings us to our first massive, flashing neon sign of the day. Exam trap. Listen closely. Because the dealer always wins the spread, the customer always gets the less favorable price.
Always. That is the universal golden rule of market pricing. Customers buy at ask the higher price, and customers sell at the bid the lower price.
Man.
You, the retail investor, are always stepping into the disadvantage.
Wait, hold on. Let me push back on this for a second, because this always infuriates new investors.
I get it.
Why does the system default to me getting gouged? Like, why can't I just buy it at the middle price? It feels like an arbitrary toll booth.
It does feel like a toll, yeah. But it's actually more like an insurance premium for liquidity.
Okay, how so?
The spread isn't just free money for the dealer. It's their compensation for taking on inventory risk. Think about what a market maker actually does. Their legal obligation is to provide a two-sided market.
Right, they have to be there.
Exactly. They have to stand there all day saying, I will buy this from anyone and I will sell this to anyone. The spread is the cost of immediacy.
Let's test this right now. I am going to ask you a question, and I want you, the listener, to actually answer it in your head before we reveal the answer.
You ready?
Okay, so Cautious Carl looks at a stock quotation. The bid is $50. The ask is $51. Carl is panicked. He sees a scary news headline, and he wants to buy that stock right this very second. What price does he pay? Take a beat to think about it.
Got your answer.
What's the damage?
He pays $51. He buys at the higher ask.
Because Carl wants the stock instantly, he pays the premium for that immediacy. Now, let's look at the size of the spread, because the exam loves testing this concept. Explain what a narrow spread versus a wide spread actually tells us about the underlying market.
Sure. So the spread is a direct metric of liquidity. Let's look at a heavily traded juggernaut like Apple.
Oh, yeah. Huge volume.
Millions of shares change hands every single minute. Because there are so many buyers and sellers swarming the stock, the market maker who buys shares from Carl knows they can turn around and sell those exact same shares to Diane 3 seconds later.
So they aren't holding the bag for very long at all?
Exactly. They have almost zero inventory risk. Because it's so easy to flip, the spread is razor thin. A highly liquid stock like Apple might have a spread of just one single penny.
Wow, just a penny.
Yeah. The bid is $150 and the ask is $150.01. Narrow spread equals high liquidity.
But what if Daring Diane is hunting for a massive payout in some obscure microcap biotech stock that trades maybe, 2,000 shares a day?
Right.
That stock might have a spread of 50 cents or even a full dollar. Why is it so wide?
Because the inventory risk absolutely skyrockets. If the market maker buys that obscure stock from Diane at the bid, they might be stuck holding that toxic asset in their own firm's inventory for 3 days before another buyer comes along.
And during those 3 days, the FDA could reject the biotech's new drug, the stock crashes to zero, and the market maker eats the entire loss.
Precisely. They are taking on massive risk by holding an unpopular, illiquid stock. So to compensate for the very real danger of the stock crashing while they hold it, they widen the spread defensively.
That makes sense.
They demand a much lower price when they buy it from you, and they charge a massive premium when they finally sell it. So wide spread equals low liquidity.
Okay, that makes complete sense. The spread is basically their shield.
Right.
And actually, fun historical fact, before the year 2001, stocks traded in fractions, not decimals.
Oh, fraction days.
Yeah, they traded in eighths of a dollar, meaning the minimum spread on Wall Street was 12.5 cents. Market makers made absolute fortunes because they were guaranteed a massive spread.
Yeah, it was a very different time.
When the SEC forced decimalization moving to pennies, it crushed dealer margins but saved retail investors billions.
Which is a perfect segue, actually. We know the price mechanics now. We know the bid, the ask, and the spread. But who exactly is capturing that spread, and how is Slippery Sam's firm actually getting paid?
That brings us to Section 2, trade capacity. This is all about what role Sam is playing in the transaction. Is he a principal, Or is he an agent?
And if you get these two mixed up on the exam, you are going to bleed points.
Definitely. Let's do a direct side-by-side comparison. Let's start with principal capacity.
Okay, when a firm acts as a principal, they are acting as a dealer. The defining characteristic here is that they are trading directly from their own inventory.
Got it.
The firm is the actual legal counterparty to the customer.
Going back to our car lot, this is the dealership. They own the car sitting on the asphalt. When you buy the car, you are buying it directly from the dealership's balance sheet.
Exactly.
And how does a principal get compensated?
Through a markup or a markdown. When they sell a security to you out of their inventory, they apply a markup to the ask price. When they buy a security from you to put into their inventory, they apply a markdown to the bid price.
So their profit is baked invisibly into the net price you pay.
Right. Now, compare that to agency capacity.
Okay, lay it on me.
When a firm acts as an agency, they are acting as a broker. They are purely a middleman.
A middleman?
Yes. They do not use their own inventory. They don't risk their own capital. Their only job is to go out into the open market and match the customer with a third-party buyer or seller.
Okay, so this is like a real estate agent. The agent showing you the house doesn't own the house. They are just facilitating the marriage between you and the seller.
Perfect analogy.
And because they aren't taking on the risk of owning the property, how are they compensated?
They charge a commission. This is a separately disclosed explicit fee for their matchmaking services.
Yeah.
And because they are acting as an agent on your behalf, they have a strict fiduciary adjacent obligation called best execution.
Best execute.
Yes. Meaning they must use reasonable diligence to find you the most favorable price available in the market.
Exam trap. I am banging on the desk right now.
Yeah.
This is exactly how the text writers will try to confuse you. They will give you this long, convoluted paragraph about a trade and then ask, in what capacity did the firm act?
Yep, they love doing that.
The cheat code is this. Compensation type reveals capacity.
Always look for the money. If the question states the customer paid a commission, the firm acted as an agency, a broker.
Commission equals agency.
If the question states the firm applied a markup or a markdown, the firm acted as a principal, a dealer. Match commission to agency and markup to principal.
But wait, this is Wall Street where nothing is ever that clean. There is a weird Frankenstein hybrid we have to talk about, the riskless principal transaction.
Ah, yes, the riskless principal.
Yeah.
This concept is a major stumbling block for students.
I'm going to challenge this right out of the gate because the name itself is an oxymoron.
It really is.
You just said a principal, by definition, takes on inventory risk. How can a principal be riskless? It sounds like a semantic loophole Slippery Sam invented to charge a markup instead of a commission.
It totally sounds like a loophole, but it's a heavily regulated one. Here is the mechanical workflow. Slippery Sam receives an order from Cautious Carl to buy 1,000 shares of a specific corporate bond.
Okay.
Sam's firm doesn't actually own that bond. It's not in their inventory. So Sam goes out into the broader market, buys the bond from another dealer for his firm's own account, and then instantaneously sells it to Carl at a markup.
Instantly. So the firm held the bond in their inventory for what, a microsecond?
Exactly. It functions economically exactly like an agency trade because Sam took on virtually zero market risk. He already had the buyer lined up before he executed the purchase.
So why not just do an agency trade and charge a commission? Why jump through this microsecond inventory hoop?
Well, often it's about the firm's trading infrastructure or the specific market they're accessing, like over-the-counter bonds, where principal trading is just the standard plumbing. Gotcha.
But here is the catch for the exam. Even though it feels like an agency trade, it is legally and technically a principal transaction.
Because for that 1 microsecond, the firm owned it.
Yes. And because of that, FINRA rules mandate that it must be explicitly disclosed on the customer's trade confirmation as a riskless principal transaction, and the markup must be disclosed. They cannot hide the profit.
Okay, so we have principal, agency, and riskless principal. Let's bring Slippery Sam's greed into the spotlight here.
Let's do it.
Sam is looking at his order book. He sees Cautious Carl wants to buy 100 shares of IBM. He sees Daring Diane wants to sell 100 shares of IBM. Sam thinks, wait, what if I act as a principal to buy the shares from Diane, hit her with a markdown, hold them for a second, and then act as an agent to sell them to Carl and charge him a commission?
Double dipping.
Right. He thinks, I can double dip on the exact same shares.
And that scheme runs headfirst into the dual capacity prohibition. Sam cannot do that. He cannot act as both a principal and an agent in the exact same transaction.
Explain the why behind that regulation. It is the ultimate conflict of interest. Think about the opposing motivations here. As an agent for Carl, Sam has a legal duty of best execution. He must fight to get Carl the lowest possible purchase price.
Right.
But as a principal, trading from his own inventory, Sam's goal is to maximize his firm's profit by selling to Carl at the highest possible price. He cannot aggressively negotiate against himself. He cannot serve two masters simultaneously.
Is it a complete permanent ban under all circumstances, or is there like a way Sam can pull this off legally?
There is a pathway, but it requires radical transparency, which Sam obviously despises.
Naturally.
To act in dual capacity, specifically in certain advisory or cross-trade situations, Sam must provide full, explicit written disclosure to both customers, and he must obtain their explicit consent before the trade is executed.
Which, realistically, if you call a client and say, hey, I'm going to charge you twice and act against your financial best interest for part of this trade, sign here, they are going to fire you.
Exactly. The disclosure requirement effectively kills the conflict in the dark.
All right, pattern interrupt. Shake out your arms, roll your shoulders, take a deep breath.
Reset.
We just survived the foundational plumbing, but the exam loves this next section, so lock your focus back in. We know the price, the spread, and the broker's capacity. Now, how do Daring Diane and Cautious Carl actually hand their instructions to the broker? Let's dive into Section 3, Order Types.
This is where the strategy becomes actionable. An order is simply a set of rigid instructions given to a broker-dealer, and every single order type is basically a tug-of-war between two competing desires: execution speed versus price control.
Let's start with the two absolute heavyweights of the market: market orders versus limit orders.
A market order is the ultimate weapon of speed. You are telling the broker, execute this trade NWO at whatever the best available price is in the order book.
Just get it done.
Yes, you are guaranteed that the trade will happen instantly. You surrender all control over the price you will receive.
This is Daring Diane's weapon of choice. Diane is scrolling Twitter. She sees a rumor that a major tech company is acquiring a small AI startup. She wants shares of that startup immediately before the rest of the world reacts.
Right. Speed.
She doesn't care if she pays $50, $52, or $55. She slams the buy market button. Boom, it fills instantly. Speed over price.
Now, compare that to Cautious Carl. Carl would rather eat glass than use a market order. Carl uses a limit order.
Because Carl demands absolute control.
Exactly. A limit order dictates that you will buy or sell only at a strictly specified price, or better. The broker is not allowed to execute the trade if the market price breaches that limit.
So if Carl wants to buy a stock and it's currently trading at $50, but Carl's spreadsheet says the intrinsic value is only $48.
He waits.
Right. Carl places a buy limit order at exactly $48.
And here's the fundamental trade-off. Carl has complete price protection. He will absolutely not pay a single penny over $48. But what is he risking?
Execution. The stock might never drop to 48.
Yeah.
It might shoot up to 60, then 80. Carl gets to be right about his price, but he misses the entire rally because his order never triggered.
Precisely. Market equals execution guarantee, no price guarantee. Limit equals price guarantee, no execution guarantee.
Okay, those are the vanilla orders. Now we enter the danger zone. Stop orders and stop limit orders. Let's unpack the standard stop order first. Retail investors usually call this a stop loss.
A stop order is essentially a dormant tripwire. It sits quietly in the broker server. It isn't the live order yet.
Just waiting.
Right. It only activates when a specific price, the stop price, is traded in the open market. Once that tripwire is hit, the stop order instantaneously transforms into a market order.
Stop the presses. Exam trap explicit call out. I'm going to say this loudly so it echoes in your brain on test day. A stop order does not guarantee a specific execution price.
This is the single biggest misconception retail investors have, and the SIE exam preys on it. Let's look at the mechanics of why this is so dangerous. Let's say you buy a stock at $50.
Okay.
You place a sell stop at $40 to protect yourself from a catastrophic loss. You sleep well at night thinking, the absolute worst I can do is sell at 40.
But let's look at a real-world scenario. Let's look at the flash crash of 2010, or just a terrible earnings report. The market closes. Overnight, news breaks that the CEO has been embezzling funds.
Uh-oh.
The next morning, the opening bell rings. The stock doesn't trade at 49, 48, 47. It gaps down instantly. It opens at $25.
So what happens to your stop order? The moment the stock opened to 25, it traded below your $40 tripwire. The tripwire is triggered. Your dormant order wakes up and instantly becomes a market order. And what does a market order do? It executes at the next available price.
Which is $25.
Yep.
You thought you had an ironclad safety net at 40, but you got filled $15 lower in a free-falling market. That phenomenon is called slippage, and it is the brutal, terrifying reality of relying on market orders in volatile conditions.
So how do you prevent that catastrophic slippage? You use a stop limit order.
Ah, the double tripwire.
Exactly. A stop limit order requires you to input two distinct prices. The start price, which acts as the trigger to wake the order up, and the limit price, which is the absolute worst price you are willing to accept once it's awake.
So going back to our embezzling CEO scenario, you set a stop trigger at 40 and a limit price at 39. The stock gaps down and opens at 25.
Right.
The $40 tripwire is triggered, but instead of becoming a reckless market order, it transforms into a discipline limit order to sell at 39.
But here is the massive critical risk of the stop limit. Your order is now live as a limit to sell at 39. But the current market price is 25. Unless the stock magically bounces back up to 39, your order will just sit there on the books, unexecuted. You will ride that bankrupt company all the way down to zero because your limit price was never met again.
It is a terrifying double-edged sword. A stop limit protects your exact price, but you risk being trapped in a burning building because the fire escape didn't meet your pricing criteria.
That's a great way to put it.
And a regular stop order gets you out of the burning building no matter what, but you might have to jump out a fourth-story window and break your legs to do it.
That is a brilliant way to conceptualize the risk.
Yeah.
Now, let's talk about the actual mechanics of where you place these triggers relative to the current market price. Students always try to memorize complex acronyms for this, like BLISS and SLOBZs. But if you just use logic, you will never forget it.
Yes, let's explain the underlying logic. Let's start with a buy limit.
A buy limit is always placed below the current market price. Why? Because you are looking for a bargain. If a stock is currently trading at $50, you aren't going to place a limit order to buy it at 55. You place it at 45. You only want to buy if the price drops.
Makes total sense.
Buy low.
What about a sell limit?
A sell limit is placed above the current market price. If you own a stock at 50, your goal is to sell it for a profit. You place your sell limit at 60. You are telling the broker, only sell this if it rallies up to my target. Sell high.
Okay, limits are intuitive. Buy below, sell above. But what about stops? Where does a buy stop go?
A pre-stop is placed above the current market price.
Wait, hit pause. That sounds completely counterintuitive. Why on earth would you set a dormant trigger to intentionally buy a stock at a higher price than you could just buy it for right now?
Because of who uses it. Buy stops are primarily used defensively by short sellers. Yeah, if you short a stock at $50, you are betting the price will crash. But if the price starts climbing to $60, $70, $80, you are bleeding money. So you place a buy stop at 55. If the stock rallies against you and hits 55, it triggers a market order to buy the stock back, which closes your short position and stops the bleeding before the stock hits 100.
So a buy stop is simply a stop loss mechanism for a short seller.
Exactly. It caps their risk on a rising stock.
Yeah.
And finally, the sell stop. This is placed below the current market price. This is your classic retail stop loss. You own a stock long at 50, you place a sell stop at 40 to protect your downside. If it tanks, you get out.
Okay, direct question to the listener. Let's see if you absorbed that logic. Pause and think before the answer. Daring Diane has taken a massive short position on a tech company. She borrowed the shares and sold them, meaning she will lose astronomical amounts of money if the stock price goes UP.
Right.
Where does she put her buy stop order to protect her account from being wiped out? Above or below the current market price? Take a second to think about that.
Got your answer. She puts it above the current market price. If the stock starts climbing in the wrong direction, she wants that tripwire to trigger so she can buy the shares back and escape the trade.
Yes. If you understand the why, you don't need the acronyms. Okay, so we've covered the order types. We have the price, the capacity, the instructions. But how long do these orders just float out there in the ether if they don't fill immediately? That brings us to section 4, time and force, the ticking clock.
Every single order has a duration. If you submit an order and you do not specify a duration, the system applies a default. And that default is a day order.
Meaning what exactly?
Meaning, if the order is not executed by the time the closing bell rings at 4:0100 p.m. Eastern, it is automatically canceled and purged from the system. It simply expires.
What if Carl wants his limit order to buy Apple at $100 to just sit there for weeks or months until a market correction finally hits his price?
Then Carl must explicitly designate the order as GTC, good till canceled. That order will remain open and live on the broker's order book indefinitely, or at least until Carl logs in and manually cancels it, or until it finally executes.
Okay, day and GTC are the easy ones, but now we have the confusing three, the institutional order types that sound almost identical but have vital, heavily tested differences: IOC, FOK, and AON. I'm going to use an absurd analogy here, and then we'll apply it to the real market.
I'm intrigued. Let's map this out.
Let's imagine daring Diane is throwing a massive wild block party, and she needs to order pizzas. Lots of pizzas. Diane calls the local pizzeria and says she needs exactly 100 pizzas. Let's apply these three order types to her request. Let's start with FOK, fill or kill.
FOK is the most aggressive, demanding order type. It requires two strict conditions simultaneously: immediate execution, and D, the entire full quantity.
So Diane yells at the pizza guy, "I need 100 pizzas right this exact second, or I am hanging up the phone and taking my business elsewhere."
Right. If the pizza guy says, well, I have 50 hot right now and I can bake the other 50 in an hour, Diane yells, "Kill it," and hangs up. No partial fills allowed, no waiting allowed, all 100 right now, or nothing.
Okay, now let's modify her order to IOC, immediate or cancel.
IOC relaxes one of the rules. It still requires immediate execution, but it allows partial fills.
So Diane calls and says, "Give me whatever pieces you have ready right this second and cancel the rest of the order." The pizza guy says, "I have 40 pizzas hot right now." Diane says, "Great, I'll take the 40 right now, cancel the other 60. Immediate action, but partials are perfectly fine.
And finally, AON, all or none.
This one flips the script. AON requires the full quantity, but it does not demand immediate execution.
Exactly. Diane tells the pizza guy, "I need exactly 100 pizzas. I will sit here in your waiting room for 3 hours if I have to, but I will not leave until all 100 boxes are stacked and ready to go together."
She refuses a partial fill of 50 now and 50 later, but she is willing to let the order sit there. Now, let's take Diane's pizza party and scale it up to institutional reality. Why do these actually matter? Let's say a massive hedge fund is trying to offload 500,000 shares of an illiquid small cap stock.
If the hedge fund uses a market order, they will crash the stock price themselves. The first 10,000 shares will sell at $20, the next at $19, and by the time they finish selling, they'll be getting $12 a share.
So they use an IOC immediate or cancel. They ping the market. Take my 500,000 shares at $20 right now. The market only has buyers for 100,000 shares. The IOC order fills the 100,000, cancels the remaining 400,000, and prevents the hedge fund from accidentally driving the price down to zero.
What's fascinating here is how FOK and AON both require full fills all 500,000 shares, but only FOK demands that it happen instantly. FOK is immediate. AON can wait.
If you remember Diane's pizza party, you will nail those definitions on the exam. FOK, full and instant. IOC, partial and instant. AON, full and wait.
Now, let's pivot the power dynamic. What if cautious Carl is just too paralyzed by anxiety to pick a stock? Or Diane is too busy throwing her party to watch the market ticker? They decide to hand the keys over to Slippery Sam. They let the broker make the decisions.
Oh boy, Slippery Sam taking the wheel. That brings us to Section 5, discretionary versus non-discretionary orders.
The regulatory rules change drastically the moment the broker assumes decision-making power. We have to clearly define what legally constitutes a discretionary order. And there's a perfect framework for this, the 3 A's.
Right. If Slippery Sam is making the final decision on any one of these 3 elements, the order is legally discretionary. The 3 A's are asset, action, and amount.
Let's define them. Asset. Which specific security are we trading? Are we buying Apple, Ford,
Action. Are we buying or are we selling?
Amount. How many shares, or what is it, the total dollar volume of the trade? 100 shares, $10,000 worth.
If Sam chooses the asset, the action, or the amount, he is exercising discretion. And because he is essentially playing with the client's money based on his own ideas, it triggers immense regulatory oversight.
Exam trap. Explicit call-out right here. If an account is discretionary, 2 specific compliance hurdles must be cleared, and the exam will deliberately try to confuse the timing of them. First, written authorization.
Also known as a power of attorney or trading authorization. This written, signed consent from the customer must be on file at the brokerage firm before the very first discretionary trade takes place.
Before. It cannot be retroactive. If Carl calls Sam from the golf course and says, "Hey man, the market is tanking, I trust you, just sell whatever you think is bad today, I'll come into the office and sign the paperwork tomorrow," can Sam legally make the trade?
Absolutely not. Verbal consent means nothing for discretion. Written before the trade, period.
Okay. What is the second compliance requirement?
A principal at the firm, a designated supervisor, must approve each discretionary trade promptly.
Notice the critical difference in timing. Written authorization before the trade. Principal approval promptly after the trade. Do not let the exam flip those on you.
Right.
The principal doesn't have to pre-approve the trade before Sam hits the button, but they have to review it promptly that same day to make sure Sam isn't churning the account just to generate massive commissions for himself.
Now, here is the most nuanced, heavily tested loophole in this entire section, the time and price exception.
This is a massive concept. We just established that the 3 A's trigger discretion: asset, action, amount. But what if Sam only decides when to execute the trade, or at what price?
If Sam only chooses time or price, it is legally not discretionary.
Explain the logic to the listener. Why isn't that considered discretion?
Because the customer has already made the critical fundamental investment decisions. The customer already decided what company to buy, whether to go long or short, and how much capital to risk.
Exactly.
They are simply asking the broker to use their professional market intuition to get a slightly better execution throughout the trading day.
Hey, Sam, the market is super volatile this morning. Buy 100 shares of Apple, but don't do it at the open. Wait until you think the price is right today.
Exactly. The customer gave the asset Apple, the action buy, and the amount 100 shares. Sam is only choosing the time and price. Therefore, no written power of attorney is required.
But there is a huge restrictive condition on this exception. What is it?
The time price exception only lasts until the end of the business day. It is effectively a day order.
Right.
If Sam watches the tape all day and doesn't find the right price, he cannot decide on his own to hold the order overnight and execute it tomorrow. If he executes it the next day without calling the client back, it becomes an unauthorized trade, which is a massive FINRA violation.
Let's test this concept. Direct questions to the listener. I'm going to give you 2 scenarios. Pause and determine if it is discretionary or not. Scenario 1. Carl calls Sam and says, I have $10,000 sitting in cash. Invest it in something good. Is this discretionary? Take a beat.
So what's the verdict?
Yes, it is heavily discretionary. Carl gave the amount $10,000 and the action invest or buy, but Sam has to pick the asset, something good. Since Sam is picking the asset, it requires a signed power of attorney beforehand.
Scenario 2. Carl calls Sam and says, buy 100 shares of Microsoft whenever you think the market bottoms out today. Is this discretionary? Think about it.
Righty.
Not discretionary. Carl gave the asset Microsoft, the action buy, and the amount 100 shares. Sam is just utilizing the time price exception, which is perfectly valid without written consent until the 4:00 p.m. bell rings.
Boom. If you systematically identify the 3 A's, you will ace every discretion question on the exam. Now, while we are talking about Slippery Sam making recommendations to Carl, we have to address the regulatory difference between solicited and unsolicited orders.
This distinction is entirely about the origin of the idea. Did the client bring the trade idea to the broker, or did the broker pitch the idea to the client?
If Sam calls Diane and says, hey, I was reading a research report this morning, and I really think you should allocate 20% of your portfolio into this new leveraged AI tech fund, that is a solicited order. Sam, the professional, recommended it.
And the second Sam recommends it, he triggers a cascade of regulatory hurdles. First, FINRA Rule 2111, which is suitability. Sam has a strict obligation to prove that this highly volatile leveraged fund is suitable for Diane's specific investment profile, her age, her risk tolerance, and her liquidity needs.
And beyond basic suitability, he triggers regulation best interest, or Reg BI. This is an SEC rule born out of the old fiduciary debates. It dictates that when a broker-dealer makes a recommendation to a retail customer, they must act in the customer's best interest, and they absolutely cannot put their own financial interests like a massive commission payout ahead of the customers.
So if Sam recommends a proprietary mutual fund because it pays him a huge bonus, but there is an identical, cheaper ETF available that would be better for Diane, Sam is violating Reg BI.
Which brings us to Slippery Sam's favorite scheme. Let's say Sam wants to pitch a terrible, high-commission, super risky penny stock to cautious Carl. Sam knows Carl is conservative. Sam knows this stock would fail a suitability review instantly. So what does Sam do?
Oh, this is classic Sam.
He pitches the stock over the phone. Carl eventually caves and buys it. But on the official order ticket, Sam checks the box that says unsolicited.
He intentionally mismarks the ticket. By checking unsolicited, Sam is legally trying to tell his compliance department, hey, I didn't recommend this garbage. Carl just called me up out of the blue, having read a Reddit thread, and demanded to buy this stock. It was entirely his idea, so I don't have to prove suitability or adhere to Reg SHO.
That is a severe violation. FINRA Rule 4514 requires every single order ticket to be accurately marked. You cannot hide behind a false unsolicited tag to bypass compliance scrutiny. If the firm audits his emails or phone logs and finds he pitched it, Sam's license is in jeopardy.
But let's flip the scenario. What if it truly was unsolicited? What if daring Diane calls Sam at 3:00 a.m., leaves a manic voicemail saying, "Sam, sell my entire boring retirement portfolio at the open and put every single penny into triple leveraged gold futures. Don't argue with me, just execute it."
Well, it's completely her idea. It's unequivocally unsolicited. So Sam is off the hook, right? He just executes the trade and collects his commission.
Actually, no. And this is where the exam gets really tricky. Even unsolicited orders have regulatory boundaries. A registered rep cannot simply shrug and say she asked for it if the requested activity is blatantly inappropriate or if it looks like outright market manipulation.
Wait, really? So Sam actually has to step in and act as a paternalistic gatekeeper to save Diane from herself?
Yes. Unsolicited orders must be accepted in good faith. If a client demands a trade that is so profoundly disastrous, like an 80-year-old widow demanding to put her entire life savings into naked call options, or if the trades indicate illegal wash sales or spoofing, Sam has a regulatory obligation to flag it, halt the execution, and bring it to his principal. You do not just blindly execute a financial suicide mission just because the client initiated it.
Exam trap. Do not let the exam trick you into thinking the word unsolicited means the broker is absolved of all responsibility. The firm still holds liability to ensure the market isn't being abused and the client isn't the victim of obvious fraud.
Okay, we've built the mechanical foundation. We have the price, the broker's capacity, the order type, the timing, the authorization, and the origin. Now, what direction do we actually think the market is going? Let's get into Section 6. Market outlook and positions. Bulls versus bears.
This is where strategy actually begins. Every mechanic we just discussed is deployed based on your fundamental market outlook.
I always visualize the animals here because Wall Street loves its metaphors. If you are bullish, you are expecting the price of the broader market or a specific security to rise. Think of an attacking bull. A bull attacks by lowering its head and thrusting its horns UP into the air. Bullish equals up.
And if you are bearish, you're expecting the price to fall. A bear attacks by standing on its hind legs and swiping its heavy clawed paws down. Bearish equals down.
So if you are bullish, the most traditional fundamental strategy is to take a long position.
Taking a long position simply means you bought the security and you own it outright. And because you own it, you profit directly when the price rises.
Let's define the exact risk profile of a long position. What is the maximum potential gain?
Theoretically, it is unlimited. A stock's price has no mathematical ceiling. It can rise indefinitely. If you bought $1,000 of Amazon in 1998, your gain has been astronomical. Unlimited upside.
And what is the maximum potential loss?
Your maximum loss is strictly limited to your initial purchase price. If you buy a stock for $50, the absolute worst case scenario is the company goes bankrupt, the stock goes to zero, and you lose your $50. You cannot lose more capital than you originally invested.
You can hold a long position in a standard vanilla cash account. It's simple. But what if you are bearish? What if daring Diane reads a forensic accounting report, decides a company is an absolute fraud, and expects the stock price to plummet? She takes a short position.
Short selling. This is one of the most mechanically complex concepts for new students to conceptualize, but it is heavily, heavily tested.
I'm going to explain short selling using a ridiculous analogy because the mechanics are so strange. Let's say you have a neighbor who owns a really expensive, pristine riding lawnmower. It's worth exactly $2,000.
Okay, I'm following.
You look at the calendar and you realize it's late November, winter is coming, nobody is going to be mowing their lawn in 2 months. You predict that the secondary market value of riding lawnmowers is about to crash. You are bearish on lawnmowers.
So what do you do to profit off that drop?
You go to your neighbor and you ask to borrow his lawnmower. You take it out of his garage and you immediately roll it down the street to the local pawn shop and you sell it to a stranger for $2,000 cash.
Wait, you literally sold an asset you did not own.
Exactly. I borrowed it and I sold it. Now, I have $2,000 in my pocket, but I have a massive liability. I owe my neighbor one riding lawnmower. I wait 2 months. Dead of winter hits. 2 feet of snow on the ground. Just as I predicted, the price of lawnmowers crashes. I walk into Home Depot and I see the exact same model of lawnmower on clearance for $1,000.
So you buy it for $1,000.
I buy the brand new mower for $1,000. I roll it over to my neighbor's garage. I return the mower to him, fulfilling my obligation, and I pocket the $1,000 difference. That is the mechanical life cycle of a short sale.
In market terms, you borrow the stock from your broker's inventory. You sell it at the high current market price. You wait for the price to fall. You buy it back in the open market at the lower price, an action called covering the short. You return the borrowed shares to the broker. You keep the price difference as profit.
But wait, we have to inject some real market mechanics into this analogy, because the SEC doesn't just let you sell phantom shares. Slippery Sam can't just press short on his keyboard. What is Regulation SHO?
Regulation SHO is a crucial SEC rule that prevents naked short selling. Before Slippery Sam can execute a short sale for Diane, he has to perform a locate. He must confirm that his firm actually has the shares available to borrow or can reasonably get them before he allows her to sell them. You can't sell a lawnmower that doesn't exist.
Now, we have to talk about the terrifying risk profile of a short sale, because this is where the exam will absolutely try to bury you. Exam trap, explicit call-out.
What happens if your fundamental prediction is wrong? What happens if there is a massive global supply chain shortage of lawnmower parts, and instead of the price dropping to $1,000, the price of that lawnmower shoots up to $10,000?
I am in catastrophic trouble because I have to return a lawnmower to my neighbor. I am legally obligated. I have to go to the store and buy it at the new massively inflated price. I only collected $2,000 from the pawn shop, but I have to spend $10,000 to buy it back. I just lost $8,000 out of pocket.
And what if the price goes to $50,000 or $1 million?
I lose my house. Because a stock price can theoretically rise forever, a short seller's maximum loss is unlimited.
This is the critical fundamental distinction you must memorize. Buying a stock, unlimited gain, limited loss. Shorting a stock, limited gain because the stock can only fall to zero, but unlimited loss.
If you want a real-world example, look at the GameStop short squeeze of 2021. Hedge funds shorted GameStop at $4, expecting it to go bankrupt. Retail investors drove the price up to $400. The hedge funds were sourced to buy the stock back at astronomical prices just to return the borrowed shares, resulting in billions of dollars in losses. That is unlimited risk in action.
And because the risk is literally infinite, regulators will not allow you to execute a short sale in a standard cash account. You must open a margin account. The broker needs the ability to monitor your collateral and liquidate your other assets to cover the losses if the trade goes against you.
Okay, so we have bulls and bears, longs and shorts. But what if we want to get incredibly sophisticated? What if cautious Carl wants to play a bullish outlook, but he is terrified of tying up $50,000 in stock? Or what if daring Diane wants to leverage her bearish outlook without dealing with the hassle of locating shares to borrow?
That brings us to Section 7, Options and the Strategy Matrix, matching risk to reality.
We need to expand heavily on this because options are historically the most intimidating topic for SIE students. But if we break down the mechanics, it's just a contract.
An option is exactly that, a derivative contract. It gives the buyer the right, but not the obligation, to buy or sell a specific stock at a specific price called the strike price before a specific expiration date. And to get that right, the buyer pays a fee called the premium.
Before we hit the matrix, explain what that premium is actually made of. Why does an option cost what it costs?
An option premium consists of two things, intrinsic value and time value. Intrinsic value is simple math. Is the option currently profitable to exercise right now? If you have the right to buy Apple at $140 and Apple is trading at $150, your option has $10 of intrinsic value.
But what if Apple is trading at $130? The right to buy it at $140 is mathematically worthless right now.
Exactly, it has zero intrinsic value. But the option might still cost $2 to buy. Why? Time value. You are paying for the probability that the stock might jump up to $150 before the contract expires next month. As expiration approaches, that time value rots away a concept called theta decay.
Okay, now let's build the strategy summary matrix. 4 foundational moves. Buying a call, buying a put, selling a call, selling a put. Let's start with buying a call.
A call option gives you the right to buy a stock at the strike price. If you buy a call, you are highly bullish. You want the stock price to skyrocket past your strike price, so your option gains massive intrinsic value.
And the risk profile?
As an option buyer, your risk is always strictly limited. Your maximum loss is simply the premium you paid to buy the contract. If the stock drops, the option expires worthless, you lose your premium, and you walk away. But your maximum gain, unlimited, because the stock can rise forever.
Okay, now let's talk about buying a put.
A put option gives you the right to sell a stock at a specific strike price. If you buy a put, you are bearish. You want the stock price to tank below your strike price, giving you the right to sell it at a premium to the market.
Again, you are a buyer, so your maximum loss is strictly limited to the premium you paid and your maximum gain.
It is substantial, but technically limited, because the stock can only drop to zero. You make the difference between the strike price and zero, minus the premium you paid to enter the trade.
Notice the universal pattern here. Option buyers have limited risk. They can only lose the chips they put on the table.
But now we cross the aisle to the other side of the trade. The option sellers, also known as the writers. This is where the risk matrix inverts completely.
Let's look at selling a call. You collect a premium upfront in cash from the buyer. But in exchange, you are now legally obligated to sell them the stock if they decide to exercise the option. What is your market outlook?
If you sell a call, you are bearish or neutral.
Right.
You want the stock to stay below the strike price. If it does, the buyer won't exercise the option, it expires worthless, and you get to keep that upfront premium as pure profit.
But what is the risk? This brings us to one of the most critical concepts on the exam: covered versus naked positions.
Let's explain this by applying it to our characters. Let's say cautious Carl decides to sell a call option on Apple with a strike price of $160. He collects a $500 premium. But Carl's cautious. He already owns 100 shares of Apple stock in his portfolio.
That is a covered call. Carl owns the underlying security. His risk is perfectly limited. Why? Because if the stock skyrockets to 200 and the option buyer exercises their right to buy those shares at 160, Carl doesn't have to panic. He just goes into his portfolio, takes the 100 shares he already owns, and hands them over. He misses out on the massive rally from 160 to 200, but he doesn't suffer a catastrophic out-of-pocket loss.
Now let's look at daring Diane. Diane wants to sell a call option on a hyper-volatile biotech stock. She collects a massive $2,000 premium. But Diane does not own the underlying stock.
That is a naked call, or an uncovered position. She's completely exposed to the elements.
So what happens if her thesis is wrong? What if the biotech company cures a disease overnight and the stock price rockets from 50 to 300?
The option buyer exercises the call. Diane is legally obligated to deliver 100 shares at $50, but she doesn't have them. So she has to go out into the open market, buy those shares at the massively inflated price of 300, just to turn around and hand them to the buyer for 50. She takes a catastrophic loss.
And because the stock can rise infinitely,
a naked call has unlimited maximum loss.
Exam trap. They will ask you this, point blank. Which of the following strategies carries unlimited maximum risk? The answers are always either shorting stock or selling naked calls.
Wait, if the risk is unlimited, why on earth would anyone ever sell a naked call?
Because they are acting like the casino. They are selling probability. Most options expire worthless. The seller collects premium after premium, relying on the theta decay, the time value rotting away to slowly drain the buyer's investment. It's a highly profitable strategy 99% of the time. But that 1% of the time, it's like picking up pennies in front of a steamroller. One mistake wipes you out entirely.
And finally, selling a put. You collect a premium. You are obligated to buy the stock if the option is exercised. Your outlook is bullish or neutral. You want the stock to stay above the strike price so the option expires worthless, and you keep the premium.
And the risk.
Substantial, but not unlimited. If the stock goes bankrupt and drops to zero, you are legally forced to buy a completely worthless stock at the higher strike price. You lose the strike price minus the premium you collected.
So, synthesizing all of this,
Yeah.
How do our characters use this matrix?
It's all about mapping strategy to psychological risk tolerance. Conservative Carl wants defined limited loss. He will almost exclusively be an option buyer. He will buy a call if he is bullish or buy a put if he is bearish. He knows exactly what his worst case scenario is before he even enters the trade, losing his premium. Or he will sell covered calls to generate safe income on stocks he already owns.
But aggressive Diane, she wants leverage. She is willing to accept infinite risk for a larger upfront payout. She will short sell stock or she will sell naked calls. She embraces the steamroller.
It's incredible how all of this connects. Every single order, every capacity, every strategy weaves together to form the plumbing of the global market. We've gone from the very first bid-ask spread to the infinite risks of naked derivatives.
And that comprehensively covers the mechanical elements that make up 31% of the SIE exam.
Let's do a rapid-fire recap to lock these exact testable takeaways into your brain right now. I'll throw the setup. You hit the punchline. Ready?
Let's do it.
The spread on a stock. Who inevitably gets the worst price?
The retail customer. You always buy at the higher ask and sell at the lower bid. The market maker wins the spread.
Trade capacity. If the scenario says the client paid a commission, what capacity is the firm acting in?
Agency. They're acting as a middleman broker.
What if the ticket says markup?
Principal. They're trading directly from their own inventory as a dealer.
Order triggers. Where does a buy limit mathematically go?
Below the current market price. You are demanding a bargain.
Where does a sell limit go?
Above the current market price. You are demanding a profit.
The 3 A's of discretion, what are they?
Asset, action, amount. If the broker chooses any of these, it is heavily discretionary and needs written approval on file beforehand.
What if the broker only chooses the time and the price of execution?
Not discretionary, but that exception strictly expires at the end of that specific business day.
And finally, what 2 specific market strategies carry unlimited maximum loss?
Short selling stock and selling naked calls.
Nailed it. Now, as we wrap up this deep dive, I want to leave you with a final provocative thought, something to chew on as you study.
We spent a considerable amount of time unpacking the time and price exception today. This regulatory idea that you can hand your broker an order and they can sit there for hours watching the tape, waiting for the absolute perfect intuitive moment to execute your trade to get you a fractionally better price.
It relies entirely on human intuition. Slippery Sam, watching the glowing ticker on his screen, feeling the rhythm of the market.
Exactly. But here is the stark reality of the modern financial ecosystem. Today, over 70% of all trading volume is driven entirely by algorithmic supercomputers, high-frequency trading. These machines are analyzing millions of data points and executing thousands of trades in actual microseconds. The bid-ask spreads on major stocks have shrunk to fractions of a single penny.
So the question is, does human timing actually benefit the retail investor anymore? Can a human broker, clicking a mouse, really spot a better price in a market that moves in milliseconds? Or is the time and price exception just an outdated legacy regulation? Is it just an illusion of control that makes investors feel better while the algorithms are the ones truly dictating the spread?
Think about that the next time you look at a stock chart.
We started this deep dive talking about how the grocery store sticker price is comforting and how the financial markets violently strip that comfort away, replacing it with a murky, high-speed negotiation. And the more you learn the mechanics, the more you realize just how deep those algorithmic waters go.
Keep pushing through the material. Understanding the why and the how is your greatest weapon against the exam traps.
Keep crushing your SIE prep. Thank you for joining us on this deep dive, and we will see you next time.